As of the close of normal trading on June 17, 2026 at 4 p.m. Eastern Time, the stock market is currently closed, and Lucid Group Inc., trading under the ticker symbol LCID on the NASDAQ, finished the session at a price of $5.14 per share, marking a positive daily move of 2.39%. While that minor intraday gain might look like a breather for a heavily battered equity, looking at this number in isolation completely misses the massive institutional drama playing out behind the scenes. The big news that sparked an afternoon surge of over 7% before settling at this closing mark is Lucid's brand new partnership with Uber and Nuro to launch an autonomous Robotaxi service in Houston by mid-2027, backed by a planned $300 million Uber investment. This looks like a massive win on the surface, but the underlying reality is that this high-profile headline is acting as a tactical shield to distract from a brutal investor confidence crisis, marked by an active securities class action lawsuit trailing a 29-day secret delivery halt. The expectation among retail traders tracking this stock on popular online investing sites is that the premium electric vehicle maker is finally finding its footing by breaking into the autonomous fleet market. Retail investors using a Robinhood app or setting up automated asset allocations through Schwab Intelligent Portfolios often see these massive multi-year corporate agreements and assume the long-term thesis is safe. They look at the fact that a fleet of 20,000 Lucid Gravity SUVs will be deployed as robotaxis over the next 6 years and believe this will instantly repair the balance sheet. But the cold reality, visible to anyone analyzing order flows on an interactive broker's platform or managing large institutional books at Fidelity Investments, is that Lucid is burning through cash at an alarming rate. Its sales multiple is sitting at roughly 1.4 times, which is more than double the broader automotive industry average of 0.6 times, making the stock look exceptionally expensive despite sitting near its 52-week lows. The reality of the execution friction is completely out of alignment with the optimistic expectation being traded in chat rooms. To understand why this gap between expectation and reality is so dangerous right now, we have to trace the recent stock movement and the volatile trading volume that has defined the last few weeks. Lucid has seen its valuation compressed by nearly 17% over the past month alone, and the stock is down a staggering 55% since the start of the year. This weakness did not happen in a vacuum. Back in February, the corporate narrative was highly optimistic. Management was bragging about record delivery streaks and calling their production scaling repeatable and structural. Retail investors added shares to their portfolios through online investment platforms, thinking the upcoming Gravity SUV launch would be a massive driver of margin expansion. But behind the scenes, a supplier quality crisis involving unauthorized changes to second-row seat components completely paralyzed vehicle deliveries for nearly a month. When the company finally reported its first quarter production numbers, it revealed that while it had manufactured 5,000 vehicles, it only managed to deliver 3,093. This massive bottleneck caused a shocking revenue miss, coming in at $282 million against Wall Street consensus estimates that were sitting up at $433 million. When that news broke, alongside an operating loss approaching $1 billion for a single quarter, the market narrative fractured. The subsequent announcement of a dilutive $1.05 billion capital raise, including a $300 million public stock offering, sent institutional investors running for the exits. Major analysts slashed their price targets, and law firms stepped in to represent shareholders who felt blindsided by the sudden shift from optimistic corporate guidance to structural operational failure. If you are holding this equity through a Fidelity brokerage account or trading the daily swings on a Robinhood stock trading setup, you are sitting in the middle of a textbook tug-of-war between retail hope and institutional skepticism. The sudden 7.5% afternoon pop we saw on the Uber Robotaxi announcement shows just how sensitive the stock is to short-term retail momentum, but the broader institutional volume is still reflecting deep caution. Comment below how many shares of Lucid Group Inc. you currently hold in your portfolio right now, and let me know if you think this Uber partnership is enough to save the company from further dilution. When you strip away the daily market noise and evaluate what this company actually does, the structural mismatch becomes even clearer. Lucid operates as a vertically integrated luxury electric vehicle designer and manufacturer, known for building some of the most efficient EV powertrains and battery systems in the world. Their flagship luxury sedan, the Lucid Air, won critical acclaim for its industry-leading range and engineering precision, and the new Gravity SUV was supposed to capture the highly profitable premium utility vehicle market. The business model relies on a direct-to-consumer retail network, avoiding traditional dealership friction, and they utilize their own proprietary financial services to handle leasing and purchasing online. Historically, the company has positioned itself as an elite competitor capable of challenging the premium market segments held by an established giant like a Tesla stock or legacy luxury brands. However, engineering brilliance has consistently failed to translate into manufacturing efficiency. The fixed overhead costs of their production facilities mean that when delivery volumes drop below key thresholds, the cash burn becomes unsustainable. Their net profit margin for the recent quarter sat at a deeply negative 364%, meaning they are losing massive amounts of capital on every single vehicle that rolls off the assembly line. This brings us to the macroeconomic and sector-wide pressures that are complicating the entire electric vehicle space. High interest rates have battered consumer affordability, making auto loan rates a massive hurdle for premium vehicle buyers. While a recent drop in treasury yields has offered a small bit of macro relief for financing, legacy automakers and pure-play EV companies alike are fighting for a shrinking pool of early adopters. Sector momentum has completely shifted away from high-multiple, cash-burning growth stories toward companies that show immediate, disciplined profitability. Even when looking at broader retail investment choices, capital is flowing out of speculative individual names and moving toward diversified options like broad market Fidelity ETFs, Fidelity mutual funds, or managed solutions through an intelligent portfolio. Investors are demanding structural stability, and a company that has to consistently dilute its current shareholders just to keep the lights on faces an uphill battle to regain institutional trust. Looking ahead, the future outlook for Lucid depends entirely on whether reality can finally catch up to the grand expectations management keeps setting. There are two distinct paths forward from this $5.14 mark. The bullish case relies on flawless execution of their technological partnerships. If the over-the-air software updates for the Gravity SUV successfully drive consumer demand, and if the technical integration with Nuro's autonomous tech goes smoothly, Lucid could transition into a highly valuable technology licensing business. This is the thesis keeping the stock alive on various investing sites. If they can validate their tech via a massive fleet deployment with Uber, they might unlock high-volume commercial revenue streams that require much less capital expenditure than building and selling individual luxury cars to retail consumers. Some analysts suggest that if this pivot works, the stock is fundamentally undervalued against its long-term asset value. But the bearish scenario is rooted in immediate structural risks. The company remains deeply reliant on external funding, with AR Third Investment Company, an affiliate of the Saudi Public Investment Fund, acting as their financial safety net. While having a sovereign wealth fund backing you is a major advantage that prevents immediate bankruptcy, it also creates an environment where retail shareholders are constantly exposed to massive dilution. Every time the company faces an operational hiccup like a supplier quality failure or a logistics delay, they are forced to issue more equity or take on expensive debt. If the ongoing class action lawsuits reveal deeper corporate governance issues regarding how the delivery halts were communicated, institutional sentiment could freeze completely, making it even harder to attract mainstream capital. Furthermore, if the broader automotive market shifts permanently toward hybrid vehicles, or if consumer demand for pure battery EVs continues to soften, Lucid's premium pricing power will erode before they ever reach the manufacturing scale required to achieve positive gross margins. When you weigh these factors against each other on an advanced interactive brokers trading platform, or analyze the risk parameters for an individual brokerage account, the conclusion is clear. Lucid is no longer just a premium car company. It has turned into a highly speculative asset operating on a razor-thin margin for error. The afternoon bounce to $5.14 shows that the market is still willing to trade the headline optimism, but a sustainable recovery requires a complete overhaul of their operational execution. The contrast between expectation and reality remains the core metric to watch. The market expects rapid technological expansion and smooth fleet deployment, but the operational reality is a history of costly manufacturing delays, negative margins, and continuous capital raises. For long-term investors utilizing sophisticated tools from Fidelity Wealth Management down to active retail setups on SoFi Invest, navigating this asset requires looking past the glamorous autonomous driving announcements and keeping a strict, unsentimental focus on quarterly delivery numbers and structural cash burn.